Registered representatives offer securities through Securities America, Inc., member FINRA SIPC. Financial advisors offer advisory services through Securities America Advisors, Inc. Forest Hills Financial, Inc. and Securities America are separate entities. This is the Keeping Your Money Show with Jamie Westenbarger and Bart Steindler.
Good morning. Welcome to Keep Your Money Show. I'm Jamie Westenbarger, joined as always by the esteemed Mr. Bart Steindler. How you doing this morning, Bart?
I'm doing great. It's another $1 million morning.
Indeed it is. Michigan's first test this weekend against a good opponent since Notre Dame. Michigan State will find out if they still have a football team after that embarrassing loss last weekend. Yes, I'm a Michigan fan. Get over it.
Yep.
This is the Keep Your Money Show, where we cut through all the bulls, the booyahs, the bells, whistles, honks, and horns to get you to the information that actually helps you move towards retirement. We got a fantastic show on deck today. Segment 1 is going to discuss how CNBC is reporting something, breaking news that they've reported that we happen to have been talking about for, I don't know,
years,
2 years, 3 years maybe, but they have discovered something that is of a shocking nature that we'll talk about.
Do we have the little breaking news song that we do here? We need to get one of those.
We do. We're going to discuss Wayne County pensions are underwater, yet the union is suing to preserve an additional what they call 13th check. Just another story on some of these pension plans and the danger that they're in. High-income retirees' tax rates may be higher than expected. We're going to talk about what maybe is missing in your retirement planning if you're not looking at the reality of taxes and what kind of impact that will have. And then we'll have Steve Broll on, our local CPA, who always has great information when it comes to tax planning. If you miss any part of the show, you can always find it on our website. Go to keepingyourmoney.com. You can also find us on iTunes, Google Play Music, SoundCloud, YouTube, and Stitcher. Just search for The Keeping Your Money Show. And I will say something about that. I was on YouTube looking for The Keeping Your Money Show for something because I wanted to send a video that somebody was asking for. It is actually really hard to find because YouTube has changed their algorithms. So you really need to type in The Keeping Your Money Show. You can't just type in like Keeping Money Show or any, because all these other things come up from all over the world. So if you're looking for it, just as a FYI to make sure you type that in. Of course, you can always give us a call. Our toll-free number is 888-98-MONEY. That's 888-986-6639. And we don't answer the phone on the air, but somebody does answer that phone 24 hours a day, and we will happily give you a call back or answer the question that you have. So let's talk about this groundbreaking news. Now, if you are a listener of the show and you listen regularly, you know that I have been preaching from the soapbox about the likelihood of there being real issues with people's asset allocations, because in 2008, when the market imploded and everyone went into bonds to be safe, and then bonds and stocks started rising together, I said we have a real problem here in that the correlation between bonds and stocks has been broken. And if you think about it, even in portfolios you have at work and target date funds and all these other things, the underlying concept of that is bonds are safer than stocks, and they have a reverse correlation to one another. When stocks go up, bonds generally don't do as well. When bonds do well, generally stocks don't do as well. So that's a way to balance your portfolio. It's also widely believed that bonds are more conservative than stocks. Well, the perfect storm happened. The perfect storm has continued, and the perfect storm is starting to happen again, and that is that we have these huge valuations in our market, and we have increasing interest rates. Well, if you know anything about bonds, if you buy something at a low interest rate and then interest rates go up, that low interest rate product is not worth as much anymore. So now we have this situation where earlier this week, we saw the market go through a pretty significant adjustment. And during that time, not only did stocks lose money, but also bonds did. And that's not what's supposed to happen, Bart.
Right. So go back a little, and we'll paint in a little bit of the history of how this came about. There was, and I'm not sure exactly what year this kind of started, but somebody came up with this theory, and they back tested it, and it was very, very accurate, and they labeled it, modern portfolio theory. And this modern portfolio theory is saying that there is a correlation between stocks and bonds, and what that means is when stocks act a certain way, bonds will act a certain way, and when they reverse, their activities will reverse. So how they're correlated to one another. And
1952, just so you know.
Oh, okay.
And it won a Nobel Prize.
Okay, so thank you for looking that up for me. So the theory was, if you're a moderate investor and you had 40% fixed income, which generally 60% in equities, that would take a lot of the volatility out of your portfolio. And what we've been saying for a long time is that when you get theories like that, they work until they don't work. And now we come up to 2008 and we have a glaring example where they did not work, because having the bonds in your portfolio, although it reduced the volatility somewhat, it certainly, you could not say it reduced the volatility. They did not go up in value when the stocks went down in value. They both went down in value. So earlier this week, there was a major sell-off in the market, over 800 points, and the results were similar.
In one day.
Mm-hmm. Right. So what we're saying is that, like I said, these things, they get set up and they work until they don't work. And now we're starting to see where they don't work on a kind of regular basis.
Well, and it becomes dangerous is it becomes a mantra that has been part of your life so long that you just automatically assume it to be true. It's very similar to the idea when interest rates were so low on mortgages, and people would say, well, you always pay off your house. Well, I don't know. If you have a 3.9% mortgage, maybe that's not necessarily true, but that was unprecedented. We had not seen 3.9% mortgages ever in the history of mortgages. So new information, new systems create new ideas and new opportunities. Same thing here. We've never seen the market get hammered by 40-some% only to recover, significantly quickly within a few months and skyrocket from there for almost 10 straight years. That's unprecedented. We're in the longest bull market in history. So all of these things change the information, and it's kind of, I heard an analogy I hope it helps kind of make sense, but it's like, if you lived in a house for 10 years and you knew where all the furniture was, you come down in the middle of the night to get a drink, you don't have to turn on the lights because you know the general layout in your mind. You know it to be true. But at 1 o'clock in the morning, someone moved your dining room table into the hallway. You are going to get injured,
right?
Probably significantly, because of the fact that it's not supposed to be there. Well, bonds are not supposed to act the way that stocks act, but guess what? They are. So if you think you're safer, if you think you're being conservative, you are in real. I think the most dangerous thing about it is if you have a high concentration stock portfolio, you're taking risk.
Correct.
If you're older or more conservative or both, and you're invested in mostly some type of bond portfolio because you feel you're being safer, you're probably taking a lot more risk than you realize you're taking because of this correlation that's taking place that's really not being talked about enough.
And the problem with that is once you realize that you've taken on that additional risk, it's too late to fix it because you're not working anymore.
You'll realize it when you lose.
You're not working anymore. And so then you have to make an adjustment on what your income is in retirement, because this theory that worked from 1952 up until 2007 isn't working the same now as it did then.
Yep. So the question is, what do you do? And I think it's a multifaceted question. if you listen to the show at all, you know we're not big fans of saying everyone should do this. So I don't think everyone should do anything except for everyone should reevaluate what they really understand of their investments. Maybe that means sitting down with your financial advisor. Maybe that means finding a financial advisor. Maybe that means replacing your current financial advisor. I don't know, but don't assume things to be as they were, because they're not, and be open-minded to maybe some other types of ways to replace what would normally be the bond part of your portfolio. I mean, even interest rates are coming up now. As we start to see interest rates grow, cash positions can start to make sense as part of your bond portfolio or as a replacement of the bond portfolio. If your bank's giving you 4%, I challenge you to find some type of bond out there that's going to do necessarily better than that, and your bank doesn't carry the risk, so just be more open-minded to looking at what other products and opportunities exist that can maybe help to replace that part of your portfolio, but do it in a much safer way.
Yeah, there are several options, and the idea is that if you sit down with an advisor to identify what those options are and then figure out which one fits you the best.
Yeah, and I think it, again, goes back to that this isn't your father or grandfather's stock market, and quite frankly, it's probably not the younger version of you stock market. And so we have to remember that just because it worked before doesn't mean it'll work again. And I think a great example of that is in every investment commercial you've ever seen in your entire life, there is a line in there that the SEC requires, and it says past results are not indicative of future returns. We hear it so much we don't actually probably even pay attention to it, but it really is a really important statement, because the stock market is a moving animal. It's alive. It's made up of tens and hundreds of millions of people's opinions and thoughts and ideas that create these price movements. What's happened in the past may never happen again. There's no guarantee that will happen again. So to continue to invest as if this were 1999 is a huge error, and it could have catastrophic results with your overall investment portfolio, because you're not taking into account new information about how things actually work. So if you need a second opinion, or maybe you need a first opinion, you've been doing this on your own and this is new information to you, you didn't even realize this was the case, give us a call. We'd love to sit down and talk to you. Our phone number is 888-98-MONEY. That's 888-986-6639. Absolutely no cost for an initial consultation. We're happy to help and look forward to talking to you. All right, coming up, we're going to talk about another county in Michigan struggling with pensions. Just a canary in the coal mine when it comes to some of these pension situations. Coming up next right here on the Keeping Your Money Show.
Is your 401k sturdy enough to help support your retirement goals? The Keeping Your Money Show has a team of advisors that will help you size up the assets currently in your 401k and explore asset allocation based on your goals. Call the Keeping Your Money Show today at 1-888-98-MONEY or visit keepingyourmoney.com to learn how you can start solidifying your foundation for a strong retirement plan.